Hello, I'm Darryl Gobbett. Welcome to 2013. One of the issues we talk about quite a lot in the Lucky for Some report, which looks at investment trends for 2013 and beyond, is our expectation that interest rates are going to stay relatively low for at least the next 12 months, and that investors are therefore going to have to be looking at other investments such as shares, property, infrastructure, to be getting the cash flow that they may well need through 2013, because it may not well be provided from term deposits. And the first chart sort of indicates what's happened to interest rates across a number of terms, but particularly the thin green line, which shows the market's expectation of where cash rates are going to head as a result of the Reserve Bank's actions through the course of 2013-2014. And that indicates that the cash rate's expected to drop to about 2.75-2.7% by the middle of this year, and probably stay around that level. Now, the next chart then indicates the relationship between some different sets of interest rates. So we have what we call the 3-year bond rate, which is the rate at which the Commonwealth Government is borrowing. We have the 3-year swap rate. Now, that's an indicator of the interest rate at which the major banks can borrow. And then we also show the 3-year term deposit rate and the 3-year fixed rate home loan rate. Now, as you can see from this chart, there's been quite a change in the relationship of those interest rates over the last several years. So in 2007, 2008, before the global financial crisis really hit, term deposit rates tended to be below the swap rate, which is the rate at which the major banks could borrow. But with the problems through 2009, 2010, 2011, the term deposit rates were significantly above the swap rate and also the government bond rates. And this reflected the increasing risk that was perceived to be with the banks. And so we've had a situation for investors where the term deposit rate was well above, in fact, what the banks were required to pay in wholesale markets, and was well above what big investors were also going to get by investing money with the banks. And we think that that particular phase is coming to an end, that term deposit rates are now going to be falling relative to swap rates and bond rates, and that this is going to mean that the expectation that you might be getting a 5 or 6% term deposit rate, as people have seen in the last couple of years, is really fading away, and we're moving almost back to the situation we had prior to 2007, 2008, where term deposit rates are actually going to be quite low for an extended period of time. And I'll talk about some of the reasons for that in the next video. Thank you.